Hello and welcome to Views from the Market, Midmarket Private Equity and M&A in Canada. My name is Mario Nigro, and I'm a partner in the Private Equity and M&A group at Stikeman Elliott. For today's podcast, I'd like to welcome our guest, Andrew Walton. Andrew is a managing partner at Ironbridge Equity Partners. Andrew, thank you for joining us and welcome.
It's a pleasure, Mario. Nice to be here.
Andrew, we always start our podcast by asking our guests to tell us a little bit about themselves and a little bit about, in your case, Ironbridge. So I'd love to start there.
Absolutely. So I spent 13 years. I was a partner at PwC Mergers and Acquisitions Advisory Group. And for the past 17 years, I've been in the mid-market private equity space. And I'm in my 11th year now at Ironbridge. And as you mentioned, one of the managing partners. Fortunately, along the way, I've been the CEO of a manufacturing company and the CFO of a food processing company. And as they say in this space, bruises and scars and being in the chair is very helpful when we're interacting with sellers. We can speak their language, and it's a differentiator that our managing partners have, as we all have operating experience. So that's a little bit about my background. Ironbridge, we've been around for 20 years. We've completed 55 transactions. Half of those are platforms. We focus exclusively on Canadian deals in the low middle market, specifically controlled deals. Although we don't run the companies, we have currently 16 portfolio companies stretching between British Columbia and Quebec. We do have control positions, but it's not because we run the companies. Our management teams run the companies. Could we focus on traditional industries? So in English, that means manufacturing, distribution, services type businesses. What we don't do is tech deals, software, commodities space, startups. And the team here is about 20 in Toronto. And we're investing out of our fourth fund, which is 383 million. And our focus is EBITDA, and let's call it the 7 to 20 million of EBITDA range. Hopefully that's a useful snapshot of my background and Ironbridge's.
Andrew, your experience is engaging at this moment in time because with all this kind of discussion in the world about tariffs, particularly U.S. tariffs and their impact, I wanted to kind of drill down a little bit with you in terms of how Ironbridge has been responding to this, both from a kind of deal sourcing perspective, from a portfolio company perspective, and frankly, just, how you're managing all this uncertainty over tariffs.
Well, fair question. And the listeners will be well aware of what's going on in the market. And whatever I'm going to tell you is not new news, but suffices to say, deal flow is very anemic. And it's almost like an accordion. We seem to be very busy with a fair amount of streaky deals coming in where there's reasonable volume. And then it's very quiet for periods of time. But when it's all said and done, it's been a very quiet 12 to 18 months for us. And a lot of the deals that we're seeing, we put in the scratch and dent category, where the stuff that's coming from various parties is not clean and is pretty tricky to get done in this market. And it's trying to be done within a market that is suffering from extreme uncertainty. The market was weak heading into 2024. It struggled throughout 2024, as everybody knows. And then frankly, tariffs pulled every remaining ounce of oxygen out of the room. And we always have something in the M&A market, if it's something wrong with the debt market or deal pricing, or there are some other many headwinds. But when we look at what we're dealing with today, the litany of issues is long. There's interest rates. Well, they have come down, but it's unsettled the market with what happened. We've got inflation. We've got this post-COVID hangover that we're dealing with, however you want to define that. We have recession fears. We've got the Canadian consumer is very weak. We walked through a bunch of geopolitical risk, and we've just been through the recent elections where for a period of time we were rudderless in the country. So when we speak to agents, things that are stuck in the pipeline and stalled, really you can look at it almost like three legs of a stool. The first is sellers are not confident on their outlook and their story they're trying to tell the buyers. So that's the first problem. The other leg of the stool is the agents. Those that are selling the businesses are lukewarm to kick things off because they've gotten severely burnt over the last 18 months to 2 years trying to get stuff done and getting nowhere. And thirdly, buyers like us, we've just got amplified skepticism as to what's going on. And that adds to this, it's the unconducive environment to get deal done. We need a couple of things. We need certainty and clarity to do deals, number one, because when we go to our investment committees, we have to have confidence and conviction as to what we're actually doing. So when you look at the whole M&A market right now, hopefully that clarifies our vantage point of what we're seeing in the market, that things are pretty tough. But we've been busy, and I'm happy to talk about that, Mario. The last, let's call it a year and a bit, we've actually been extremely busy. We've actually gotten a couple of things done, a couple of exits done, and very recently, a very large transaction that's actually going to be announced tomorrow publicly. So it's been busy times, but happy to talk about whichever path you want to go down.
I mean, obviously, you're still doing deals. You're in there every day. You're still trying to get deals done. Have you changed what you're looking for? Have you pivoted in any ways in terms of the type of deals you do? I mean, Ironbridge is, as you said, well known for kind of traditional kind of, industrial manufacturing, distribution businesses. Has that changed in terms of how you look at deals since this tariff uncertainty started?
Not really right now, because of what's happening in the market. We can't just change what we have built our business model around, and we think it's going to come back. Yeah, all deal environments are tough. There's always challenges. And I'm speaking through the lens of Ironbridge, which is a small sliver of the market in what we do. But getting deals done over the past year and a half have been extremely tough as nails, actually. And processes have been taking extremely long. And there's significant fall off between NDAs being signed and LOIs getting done, just an eye-watering drop-off. And I attribute that to PE funds are not very busy and expressions of interest are effectively free to throw in the middle. But we've not changed our strategies to buy Canadian-based head office businesses, grow them, hopefully expand them into the US. So that's our playbook. And happy to lean into the conversation on tariffs in a specific part of your conversation on the pod. But, with respect to how getting deals done in this market is changing our strategy. We've been fortunate enough to sell 3.5 businesses and get a couple of tuck-ins done. And we just recently closed a very large platform deal. So we're getting things done. Portfolio companies are obviously facing some headwinds with tariffs, which I'm sure we'll get into in the pod. But getting deals done in this market have been very, very tough. Just actually a side note, just to give you some perspective on this. We have a deal that ultimately closed in September, but it was meant to close in May of last year. And this is a deal that we launched the book 1.5 years before closing. And I've tried to put my finger on it, but a couple of observations. Diligence was very intense and drawn out. Secondly, the buyer conviction pool was very weak, and we had to stay very patient because this deal was delayed closing by 5 months, but actually from start to finish, from the time the buyers got the book, it took 1.5 years, as I mentioned. And, the company was performing very strongly throughout, and it was a fantastic deal for us. But it's very tough out there, and things are fragile. So just looping back to your original question, we're not changing our strategy, but getting things done at the moment have been very difficult.
You highlight one of the things that we all have been noticing in the M&A market, which, you said it very well, it's just a lot harder to get deals done. They take more time. We've also noticed, knowing your thoughts, Andrew, is there's just more diligence being done. Not only diligence on your part as a buyer, but diligence from banks, from third parties. There's just a lot more of a microscope. I wanted to get a sense from you how you're managing that diligence process, because if you remember, we were both there in 21, 22, and actually it was the opposite. There was so little diligence being done. We were amazed. We've kind of almost gone literally to the opposite side, where people are much more purposeful on diligence, much more. I get a sense from you in terms of your own processes internally and how you're looking at diligence, and obviously how you're managed banks who are looking at diligence much more intensely. And I mean, has things changed for you from a diligence point of view when you look back the last few years in terms of your internal processes or what you're looking for, or some visibility into financial statements, more forward visibility before you get a deal done?
Yeah. So I've touched on a few of these points, but the degree of skepticism from the investment committee, from the banks, from the various parties involved, and also the deal team that is leading the deal has been very high. And to that topic of that deal that I mentioned just a bit earlier, that it took it a year and a half to get that deal done from the time we launched the SIM until we finally exited. And I'd love to give you the specific reason, Mario, why it took so long. But as I mentioned, it's just the process is drawn out. The buyers have a sense of time because the market is not putting significant pressure on them, that the sellers have multiple alternatives to go to. And once they get locked up on a deal, as you know, the power shift happens and the buyer is in control of the timeline. And we experienced that over the last year and a half in spades, where things just took forever. But we still were able to get things done. And that's the good news, is things are still getting done on companies that are those businesses that are maybe a little bit insulated from tariffs, where they are trading, and they're a small group, but they're trading very well. And when those businesses do come on the market, there are certainly ones that are getting chased. But to your earlier point, the diligence process is way more intense than the earlier part of my career, when things are running in all different directions and it's easier to get deal done.
We had discussed earlier, Andrew, that for you, one of the things that's great about IX is a great Canadian mid-market private equity story. You focused yourself, you're known for focusing on buying Canadian mid-market companies. Obviously, you've done that in the context of free trade. You've done that in a world that seems to have changed overnight for us all in the last 6 months. We've talked about sourcing and deal opportunities, but you're also managing a portfolio of companies that have a lot of cross-border activity, with the U.S. market as being key. How have you been managing that? I mean, there's a lot in that.
Yeah.
One of the things that I know in some of your portfolio companies, you have Canadian companies that have been selling heavily into the U.S. How are you dealing with some of the issues that this kind of tariff threat or tariff uncertainty has created on your portfolio company as a proud Canadian mid-market private equity fund that's trying to do, and grow Canadian business in Canada?
Well, it's very real for us, Mario. We have 11 of our 16 portfolio companies export to the US. Some are 10% of their business, some are 80% of their business. So it's very real, and primarily in our manufacturing businesses and food businesses, because as I mentioned, our playbook is we buy Canadian businesses, we grow and professionalize those. And if they've already got a footprint in the US, we accelerate that footprint, or we will greenfield or do an acquisition in the US and build a presence there, because we know that our exit options dramatically increase if we have US presence. Doesn't have to be 50% of the business. It can be 10% or 20%, but the buyers look at that and say, look, the hard work has been done. This business is successful in the US and we can take that platform and accelerate it. Fortunately, at this point, we effectively fall under USMCA for all of our businesses. There's some on the margin that have some challenges on tariffs, but there are no quick fix short-term strategies that we have to minimize tariffs, because you cannot avoid them. But in managing through this, what I can tell you is it creates immense indecision. This on-off process that we're going through makes it impossible to execute on either choosing to build operations in the US, or to change our strategy, or move the business into different areas that allow us to minimize tariffs. So these discussions that we are having with our companies and their customers are, at this point, is who's really bearing the cost? Because that's the real question that's coming up right now. Is it us, or is it our customer in the US, or is it the end consumer? And how are we going to split that up? And those are tough conversations. And so far, what we've done is we've completed our tariff feasibility and planning for all of our portfolio companies. And I'm happy to get into some specifics of what those planning strategies have entailed. Some are simple, some are complicated, but we will implement those tariff strategies if tariffs actually physically go live. But that's the short-term solution. The long-term solution is we'll have to figure out how we're going to be moving production or facility openings in the US. And there's just an observation I wanted to make because nobody really talks about the second-order consequences of what's going on. And I just wanted to highlight this because it's very real for us. It's the first time that our customers are being receptive to our competitors for no other reason that the market has created the situation where surety of supply has become a big question for our customers in the US. And there is little to no doubt that this turmoil, for me, has much longer lasting impacts on the Canadian exporters that we're not really aware of how it's actually manifesting right now, but we will lose market share because previously our customers were happy with us. And when competitors arrived with good product, good service, they would go, you know what, we are happy with what we're getting. We don't need you now. And the conversation goes nowhere. Well, I can tell you now, Mario, they're having a very different conversation. And our customers are entertaining them bidding on the work. And some of that, unfortunately, is going to stick. You know, if it's helpful to you, I'm happy to talk about some of the short-term strategies on the specific short-term tariff activities that we are working on that we will implement. But it may be a little bit too much for the podcast on, you know, the 2 or 3 things that we are currently live on doing to minimize.
No, please.
Okay.
Tell us the 2 or 3 things. Yeah, that'd be great.
Yes. So most of the listeners, if they have the situations we are living through, would already be on this. And I'll split it between the super simple and kind of getting a little bit more complicated. The first is transfer pricing. And you need a US entity for this already, or you can set one up. And effectively what it's doing is instead of you selling to the US entity with a 10% markup, you're selling it now across the border at a 5% markup. And obviously that lowers the cost on which the tariff will be applied. So you're saving on the tariffs. There has to be contemporaneous documentation for the CRA, and it's a fair process to get that in place, but it's very doable. But you are creating a few other issues. As I've said, none of these things are perfect, and you can't avoid tariffs. You can just lower the pain. But what you are doing is you're trapping more profit in the US. So where previously you were trapping less profit, you're now trapping more profit, which comes with its own issues because you've got a 5% withholding tax to try and repatriate that money back to Canada. But if, like many of our portcos have, we have US debt. So we're trapping profit in the US and we can use those profits to pay down our US debt. But you can't wake up after the events and go, we need to reconstruct our debt positions and create US debt. Not going to be an easy process and will have lots of negative tax consequences. So that's the first piece, looking at your transfer pricing. And you obviously have to operate the business and the transfer pricing within the boundaries of what the CRA is going to be allowing you to do. The second thing, which is a little bit more complicated than the first, which is splitting your IP away from your manufacturing costs. So your intellectual property, separating the two so that when you are invoicing a customer, you are only getting tariffed on the portion of the invoice that relates to manufacturing, which obviously can lower the price quite substantially anywhere, depending on how important your intellectual property is. Obviously, there are studies that need to be done. So that can be a material mover in minimizing the tariffs on what you're getting charged. The third, which is even more complicated, but also very doable, is you effectively are creating a intercompany sale between 2 Canadian entities. You'll create a subsidiary in Canada. You will sell the product to that Canadian 100% owned subsidiary. And that transaction is viewed for whatever reason, and it's been court tested, that is considered the first sale for export. And that price that you're transferring at becomes the price that the tariff is applied to, not the price that you are actually selling the product to the end customer in the US at. So those are three strategies. They scale from super simple to slightly more complicated, but they will allow you to minimize or at least deflect some of the pain. But there are no quick fixes here, and none of these things are perfect. They all come with a little bit of hair.
When I hear you, Andrew, I hear about the complexity of the environment you're dealing with, and obviously the uncertainty in trying to manage it. I wanted to, I always ask our guests, I call it the crystal ball question, given all that you're working on, all that you're seeing, the uncertainty, the recession, the R word is coming into play now. Where does this go? Where are you and Ironbridge as you plan out? Where do you think this market's going?
Well, I wish I had a crystal ball, because if I did, I wouldn't be working. But I also wish I was the bearer of slightly better news. And I think we entered into a pretty turbulent time frame where we are currently internally focused, both our companies and the PE funds. And I'm just going to give you this sort of the M&A landscape lens rather than a macro lens. But we're very internally focused at the moment. And until some blue skies show up, things are going to be pretty wobbly. And that really just comes down to tariff clarity. At the end of the day, Mario, we just want to get back to business. We want to get back to focusing on growing and executing our strategic plans with our businesses. I'm certainly not going to be the one that predicts what happens with deal volumes. But I think, as I mentioned in a panel that you and I were on back in January, it's probably the fourth quarter that we see things start to settle down if the tariffs, and this is a big if the current tariffs become manageable and they are locked down and everybody knows what they're dealing with. So we are spooling up a few things to try and hit that timeline with that window. If it's open, we're going to hit that window. But I think summer, which is always pretty quiet, I think it's going to be extraordinarily quiet. And that's where I see the next, let's call it 6 months to a year panning out.
Andrew, I want to thank you for joining us. You and Ironbridge have obviously been a part of our marketplace for a long time, and hearing your perspective and obviously how Ironbridge, a very successful PE fund, is kind of stick handling this, has been super insightful and at least gives us some ideas as to how you're managing this uncertain environment. So thank you for sharing that with us.
Absolute pleasure, Mario, and really enjoyed that. Thank you.